Well, as it turns out, my next guest has also released a research report yesterday, and it was entitled, AI Will Kill the Tech Monopolies. Let's bring in now BCA Research Chief Global Strategist, Peter Berezin. Peter, I want to begin with the report. In your report, you start off by pointing out that the tech profits are generated from three sources. So let's walk through those and explain to the audience why they're vulnerable now.
Right. So economies of scale occur when a company has high fixed costs and low variable costs. So the more that it produces, the lower is its average cost. And that can make it very difficult for other companies to compete once that company operates at a large enough scale. Network effects occur when people use a product or service that others like to use. So that creates sort of a sunk cost. People use Facebook because their friends and family use Facebook. People use more Amazon Marketplace because that's where the buyers are. Why are the buyers there? Because that's where the sellers are. And then lastly, proprietary technology patents can often be a very important source of monopoly power. The point of the reports is that AI will decimate all three sources of monopoly power, meaning that the tech monopolies are going to really suffer.
Wow. And that's a powerful word, decimate, just annihilate them all. Do you have a time frame?
I think this will play out over multiple years, but investors are going to start pricing it in fairly quickly. Software is already a good example. Just a few months ago, the prevailing wisdom was that AI would be good for software because it would allow software companies to code more cheaply. Well, it did. That turned out to be true. The problem for software companies is that it allowed everybody else to also code more cheaply. That brought down the fixed cost of software development. And now increasingly, investors are asking themselves, will companies need to buy expensive software when they can just code their own software themselves?
You also had a piece in there about AI and the potential to upend the hub and spoke model of social media. Where are you there?
So the way social media currently works is that you have companies such as Instagram or Facebook or TikTok as the hub, and then the spokes are the users. What AI will allow is for an agentic layer to surround that hub, meaning that if you want to find out what's going on, if you want to see something interesting, rather than going to Instagram, you're just going to ask the AI. And the AI will get to know us very well, our likes and dislikes. And so what could happen is that social media platforms will go from being coveted destinations to mere repositories of content, and that could reduce their market power.
Now, the thing that everyone agrees on is that we could be in a potential productivity boom because of AI. And you wrote that, well, productivity does not necessarily equate to profits. Now, that's one that's intriguing for a lot of people.
Well, look at the EV industry. It's incredibly innovative. It has transformed the way people get around, and yet it struggles to make money. Tesla's profit margin has fallen from 12% to around 4%. The Chinese makers, perhaps with the slight exception of BYD, aren't making any money. Lucid, the other US makers, also are struggling to make money. The problem is that when you have a commoditized product, as you have with AI, these models are very, very similar. They use the same neural net transformer architecture, and that requires high capex. Often what you end up with is slim margins.
Right, and BYD stock has come off a lot. Hey, I want to ask about this table that you put out, this chart. I saw it a lot this week, all over the place. The risk to the economy. So this tech sell-off, it expands, it starts to come in, and it does mean, it does pose a serious threat to our overall economy, right?
It certainly does. U.S. households hold about 70 trillion in equity wealth. So suppose that stocks go down by 10%. That would cut about 7 trillion from their wealth. A reasonable rule of thumb that economists use is that every $1 change in equity wealth leads to a 4-cent change in consumer spending. Well, you do the math. If stocks go down by 10%, that's going to reduce spending by around $280 billion. That's almost 1% of GDP. And that's before we include multiplier effects. That's before we include the investment impact. It could damage the economy.
Yeah, and ironically enough, thinking that just the top 20% have so much wealth concentrated, maybe it's even more dire than that. Less than a minute to go. You laid out the case brilliantly. So when it all shakes out, who or what wins?
Well, that's where the most intriguing message that I've articulated comes from. If labor doesn't gain from AI, if companies struggle to gain from AI, maybe who wins are the old economy stocks. Because what's going to happen is that AI will require a lot of commodities to build all these humanoid robots that Elon envisioned. Those robots are going to be building a lot of stuff, which in turn will require commodities as input. So maybe the remaining scarce factor of production, land and natural resources, that's what goes up in value the most.
Wow, back to the future. Peter, fantastic report. Your work is always fantastic. Thank you very much. Appreciate it.